Good afternoon, everyone, and welcome to you all, and thank you for tuning in live to our Acuvest webinar, and also a welcome indeed to those listening to us on playback. Our purpose today is to provide you with some practical tips on investing, with those tips coming from three people who have operated at the top level of the investment industry and have managed through past economic and market challenges. Each of the speakers will have 10 minutes to provide you with some interesting stories and insights, and you will have the opportunity to put a question to the speakers at the end. To submit your question, you can do that at any time during the webinar via the Q&A function, which you should see on your screen. The three people joining me today are all members of Acuvest Investment Committee, but they come from very different backgrounds. Michael McCarthy is an actuary and has worked in investment markets both in Ireland and internationally for over 40 years. During that time, Michael has worked with some of the largest and most sophisticated institutional investors in the world. David Kingston is a very experienced businessman and director. While he has held many leadership positions during his career, he is probably best known for his time as CEO of Irish Life and then later as chairman of the Irish Stock Exchange. David's lifelong interest in investments and risk management continues today through his leadership of our firm's board and investment committee. And finally, we have Chris Johns. Chris is very well known in Ireland. He is an experienced economist and investment strategist. He has served as Chief Investment Officer of Fundamental Equities for State Street Global Advisors for a number of years, and he currently writes a weekly column on a Monday for the Irish and Times. So welcome to Michael, Chris, and David. Before I go to you, David, first, I would like just to set the scene, if I may. The word uncertain probably best sums up the time we live in. While Ireland is doing very well in our response to COVID-19, I think the picture globally is worrying, with now over 12 million confirmed cases. The US accounts for over 3 million of those, and yesterday the US had one of their worst days, with over 60,000 new cases and 1,100 deaths. As we all know, the response globally to COVID-19 resulted in the shutdown of a lot of economic activity and the mobilization of unprecedented supports, both from central banks and governments, as countries sought to support both their people and their businesses, with the hope that they could bridge the gap until businesses could return to some type of normality. In my view, that experiment of reopening business is playing out now as we speak, and there is a degree of uncertainty as to how, when, and indeed if all businesses can recover. But against that backdrop, I think people are will naturally question what to do when it comes to their own personal savings and pensions. If you are already invested in markets, people are likely to be concerned about the potential for a significant loss to their capital. If they are in cash, they may have two concerns. One, about being in cash when returns are effectively zero or indeed negative returns from cash. Or two, the feeling that if they were to invest now, might markets then fall significantly. David, I appreciate that every crisis is different, but the question I'll be asking you, and indeed all of our speakers today, are there lessons that we as investors can learn from the past and apply them to help us to safely navigate today's uncertainties? And David, just as I hand over to you here, I'm going to just pull up a slide, and if I can just maybe introduce it first for you. The slide that's coming up now is a picture of two quite famous people. The first one everybody will know on the left-hand side, it's President Trump. The second one, probably most people will know, but in case you don't know, the person on the right in this picture is Anthony Fauci, who is the lead medical advisor on the White House's Corona Task Force. So David, I'm actually intrigued and wondering how this particular picture fits into our discussion today. Over to you, David.
Thanks very much, John. Well, the main thing I've learned from a lifetime of investment is that you need to find out who has superior knowledge and where you personally have superior knowledge. And that's a hard thing to assess. But sometimes it's easier, and this is a classic example. You talked earlier on, John, about COVID-19, and the question I would ask of this particular slide is, which of these guys would you trust in regard to COVID-19 issues? Would you trust the big guy who makes all the noise, or would you trust the little guy who speaks slowly and ultimately has more knowledge? Now, it's very easy for us perhaps to ignore President Trump, but lots of people in America listen to him. And it just seems to me that this is the epitome of many things in investment. Look for the guy, he may be the quiet guy, or look into yourself for your quiet moments as to when you have superior knowledge and when you can use that. One of my earliest investment experiences was covering the Irish equity market about 50 years ago. It was my first job in Irish life, was to set up a research department into the Irish equity market. And we built up a research team and a body of knowledge. We wrote about every company, we visited every company on the Irish Stock Exchange, and nobody else was doing that. As a result of that, we had far better knowledge than anybody else, and it's hardly surprising that we had superior investment performance in the Irish market for 5-10 years at that time until other people caught up. Now, at the end, during that period, after about 5 years, I switched into managing UK equities. And I realized fairly quickly that I had no superior knowledge. I was taking secondhand information from other people, and there was no way that my information was going to be any better than theirs. You could find out about the odd share, but you couldn't find out enough. So after a couple of years doing that, I decided to switch to something where my superior knowledge might be in play, and that was into managing pension funds.
David, I'm interested in that, because in making a switch from investments to pensions, did that change your perspective on how to invest?
Yes, it did, because that's a good point, John, because I think when I was looking at the UK equity market, I was too focused. That there are a whole lot of broader questions that you can move on to. And this slide, which shows the equity markets over 100 years, perhaps illustrates some other points. I was probably answering the wrong question. You know, the question wasn't whether you could pick the right shares in the UK market. The question was more an overall question as how you manage money in a more general sense. And I think this chart of the equity markets illustrates a couple of points. First of all, you can see from this is for those of you who are into that kind of thing, it's a log scale, but it shows you equity markets in general have gone up over 100 years. And so I think the first and essential point of that is that you are better to be in the market than out of the market. So if you're going to try to time a market which is generally rising, you're really taking not a very clever bet. But the corollary of that, or the opposite of it, if you like, is, well, you might say, well, if it's going up all the time, why not borrow vast amounts of money and put them into the market? I have to say, I was almost burned by doing that sometime later in my life. One of my colleagues, unbeknownst to me, although I was responsible for the area, was borrowing money and investing heavily in the market. When I discovered what he was doing, or we discovered what he was doing, we stopped him. By that stage, he had handed in his notice and had been bought by another institution which thought that we were making so much money, this must be a great game. So he played that game for them, and the first year was terrific, and they made lots of money, so they doubled the bets. Unfortunately, they then went into a bear market, which lasted for a couple of years. They lost a great deal of money, far more than they'd made in the first place, and they all lost their jobs. So that is something perhaps you might be better to steer away from. I think I'd like to go on from that, John, to look at some things where you might be able to use your own ability to manage your money. And here's just 5 points that I'd like to make. The first is plan. Make a plan. That sounds obvious, but lots of people don't do it. You need to plan your future needs, and you need to match your investments to that plan. And that will throw up very interesting things. I've seen John in particular doing this with people quite a lot in the last several years, and it really is extraordinary what comes out of that. Not necessarily direct investment experiences, but other things as well. Make a plan. The second point is keep a cool head. And that's one of the advantages of perhaps of getting older. You've seen a lot of ups and downs in the world. You've seen the good times and you've seen the bad times, and they don't tend to last. So keep a cool head and don't sell out at the bottom of the market. We've seen far too many people do that. The third point is look at your personal expertise. There may be areas where you have particular knowledge, and your particular knowledge might help. Whether you have particular knowledge of an industry, you have particular knowledge of some individual manager who has a special skill, that can make life very interesting and help you along the way. Fourth point, fashion. I'll come back to my friend President Trump. Don't fall for the latest fashion. I've seen so many times. I remember early on in my career, it was mining shares. Then it was oil shares, oil exploration shares. Then it was tech stocks in the period around 2000. Maybe it's tech stocks again now. You need to be able to eliminate the fashion and the fact that it's being written up and you're hearing lots of good things about it. And the last point is to admit your bet might be wrong before it busts you. Good investment managers admit their mistakes, and that's a much harder thing to do than to say. So John, over to you again. I think that's all the points I want to make.
Thanks very much, David. I mean, there's one point I just want to ask you one follow-up question on that, because it really resonates with me when you talk about keeping a cool head during stressful times. And I think that behaviorally, that's difficult to do, because usually when you hit a situation where maybe the value of your investments are falling, whether they're in your pension or outside your pension, it can also come at other stressful times. Other things may be happening. Like in the last financial crisis, we would have seen property values, your house value is going down, people may have concerns about job security, etc. So I'd ask you just to elaborate a little bit further on that. So if there, because it strikes me that probably there's a connection between the first point, having a plan, and the discipline to it. But thought you might just comment on that, please. Yeah,
I think that is the point, John, is that the important thing is to have a plan, and also to cater within that plan for extremities. Cater in the plan for the fact that markets might go down 50% or markets might go up 100%. Or what would you do in those circumstances? And don't get yourself into a situation where you have to sell. That almost happened to me in 2008. I was lucky I was able to find a way out of it. But it's all too easy to get into a situation where you have to panic because your plan wasn't adequate. And it really is extraordinary how few people really plan out what they're going to do and what they're going to do. You can't cater for if the world blows up. There's nothing you can do about it. But in most instances, you should have a plan which will take you through.
Yeah, and I very much agree with that, David. And if I could add one point to it, I do think to the extent that you can, and it's not because we're an advisor I'm about to say this, but I do think one of the advantages of having a trusted advisor is sometimes, in order to help remove the emotion from it, it's the ability to be able to speak with somebody else who has some expertise in the area, even if it's just simply for them to restate the plan and the long-term beliefs that go into that. As somehow, what I have found with working with people over the years, that's very simple of exercise of being able to talk to somebody who's a little bit removed from your own situation is very important to counteract those behavioural mistakes.
Absolutely.
Okay, David, listen, thanks very much for that. I would now like to hand over to Chris Johns. Chris, I'm sure there's much of what David has talked about that you're likely to agree, because you and I have chatted many times about this broad question of how best to invest. But without further ado, I'm about to pull up your slide here in a second, and when I do, just get you to go through it. And I'm interested because as I pull it up, it's a slightly more complicated slide, but I do note, Chris, that like David, you have gone for a very long-term perspective. So I'm interested to see how you go through that. Over to you, Chris.
Thank you very much, John, and good day to everybody listening. This is a version of David's chart, as you mentioned, John. It's for the US equity market, and unlike David, it's got two lines rather than one. The first is very similar on a different scale, but on a slightly longer time period. This goes back all the way to 1870. The top line, we have the US equity market, and the second line on the chart is what's generally considered by most investment professionals, if not all, to be the number one driver of equity markets, and that's the profitability, the earnings of the companies that comprise whatever index that we happen to be looking at. There are lots of other drivers, but that would be number one on most people's list. And the various things that I draw from this very long-term chart and my own not quite as long experience in all markets, not just equities, and I'd echo the remarks that have just been made, which is the first point I make on this slide, which is that a long-term perspective is absolutely everything. And I'll come back to that issue of time in a moment. The chart, though, I think does pose a number of interesting questions, and I think the most important of which for today actually is the second bullet point I've got on this slide, which is ask yourself which feature of this chart interests you most. There's lots going on here. I've stated that we have the number one driver of equities is the profitability of the companies, but you can see that the relationship is very imperfect. It's not one for one. For many years, both the market and earnings grow in line with each other. And that, you can see over more recent history that they've diverged a lot. So it's not just about earnings. So you have to ask yourself, what else do you think is going on? You see lots of peaks and troughs in equities. David's talked about that. Now, if those peaks and troughs interest you and you think, well, that's something that with my superior knowledge, abilities, or whatever, I can take advantage of, then I think that tells you something about yourself. And in my world, that's not being an investor, that's being a trader. If, however, the more longer term point about markets generally, but not always going up, is the one that interests you the most, so that conclusion being invested is the right one, but carefully, that question arises then, well, what does carefully mean for me? So it's very important to look at this and ask yourself, I think, some very pertinent questions. And that raises a number of issues for me. The first one about investing markets, I think perhaps the biggest lesson of all that I've learned over many, many years is that paradoxes abound. Investing is always about taking a view on the future. And that sets up a whole industry called forecasting. And the first paradox, perhaps the prime paradox in investing, is that we are all forecasters, but forecasting is not possible. Again, I began my career many, many years ago as a professional economic forecaster in research institutes and for the British government, actually, way back in the 1980s. And I began as a callow youth thinking that forecasting the economy, although difficult, was possible. And over many years, I've come to conclude that it simply is not. It's not even nearly possible. You just can't do it. So the most important lesson that I think I've learned personally is that it's less about forecasting and more about beliefs. Going back to that question about what kind of investor are you, that raises the further question of what beliefs do I have about the future? The first belief I have as an investor is that there is going to be a half-decent future. And rather than forecasting things like the economy going up 2 or 3% next year, or interest rates going up or down by half a percentage point, ask yourself, do you think the future will be more or less like the past? Do you think it'll be worse? Do you think it'll be better? Those sorts of exercises are far more productive in terms of producing that all-important plan. The second point I'd make, and that speaks precisely to this relationship between the equity market and earnings, is that even if we could forecast the future perfectly, so for example here we would be forecasting earnings perfectly, we still don't actually know what markets would do to that perfectly forecast future. So it's another paradox. Other things are going on. The third and related thing that I have learned over the years is that time is all important. And it also sets up another of those paradoxes, because one of the mantras you will always hear from investors, from forecasters, from all people like me all the time is that we are long term. And everybody says they're long term. But this is one of the great lies that we all tell ourselves, because behaviorally, what I've observed over many years of experience is that all of us who say we're long term then behave completely differently to that claim. And it's incredibly important to remember that, and to always try to remember that when you've said you're going to behave in a long-term fashion, to actually execute on that part of the plan. Another important lesson for me is about always aiming for perfection. And frankly, perfection is the enemy of good enough. And I think from an investing point of view, good enough is what we should always aim for. And that's all about setting our expectations correctly. We can always wish that we put everything on the horse that came in first, but of course that just sets up regret. And it's very important to realize that if that's the way we're going to set our expectations, we're going to be disappointed in our investment performance 100% of the time. This is human nature, and it's important to guard against it. Always ask the right questions. Think about whether or not this question makes sense. So the strong beliefs that you have, and if you have that knowledge, that expertise that David spoke about, then you probably can combine that expertise with your strong beliefs and become a DIY investor. It's very easy. Lots of investing platforms that do low-cost investing, another important aspect of this. For most people, however, they don't have that expertise that David spoke about. So I don't think DIY investing is for most of us. Even I use an advisor, if only to get me away from those behavioral biases that I've spoken about earlier on. So you start from the premise that the future is worth investing in. You've no appetite for DIY. And the first question that is usually asked at that point is, how much do I need? Which is the wrong question. It's subtly different from how much is enough. And I could talk about this a lot, actually, but those two questions are subtly different, but produce profoundly different answers. So don't start with how much do I need. Don't start with how much is enough. Ask, how much do I need? Very, very important to get those sorts of questions right. When you're sitting down with your advisor, when you're devising your plan of whatever kind it is, always focus on costs. Another lesson learned in markets is that this is an industry that is costly, and some of those costs are worth paying, but some of them are not. Minimize costs where you can. Our main tool for dealing with all of these paradoxes and all of the uncertainties about the future, all of the ups and downs of equity markets and other asset classes, is a diversified portfolio. And that's what you should be aiming for as an investor. The type of diversified portfolio you have will be depending on your own personal circumstances. And that's another important thing to think about. And the final lesson that I will leave you with today really echoes everything that David and John has said already, is about having that plan and sticking to it. And within that plan, it's very important to have certain behaviors. Review your portfolio infrequently. Don't do it every day. Don't do it at high frequency. All that will lead to is psychological damage, trust me. By all means, embrace the new ideas. Look at market moves and what they mean when they've been big ones. Rebalancing your portfolio occasionally is very important. Reacting to big events like the ones that we're living through at the moment is certainly important, but don't do it too often. Set this plan with your advisor and don't look at markets too often between meetings and your advisor. That concludes my remarks, John. I'll hand it back to you.
Thank you, Chris. I'm particularly struck by one of your points, which is about helping people to focus on how much they need, because I have to say, one of my observations as an industry, I don't think we do this very well. And I think without helping people to do that through use of sort of tools and getting people to think about the purpose, I often say, and many clients will have heard me say it, it's not the value of the money in its own right, but it's what that money can do for you and your family that's important. And by starting to focus on that and then just starting to build out in a very disciplined way, I believe it's both possible and important, to go to your point, Chris, that you can figure out how much you need to do the things that are important to you. And that does, I think, very significantly help people to potentially avoid some of the behavioral mistakes that both you and David have spoken to. So listen, with that, I'd like to now go to Michael. So Michael, if you just give me a few minutes as we just pull up your slides. And so as we do that, the technology here. Michael, I know when we were practicing for this and rehearsing that you were going to focus in on talking about the bear market of the 1970s, and I've just pulled up there your first chart, so I'll just hand over to you.
Okay, Ian. Thank you, John, and good afternoon, everybody. You may wonder why I've chosen this particular period, and it's because I want to tell a personal story, because I started work in the investment sphere 2 months before this bear market started. So this was really my first experience of markets, and it's left a very deep impression on me. Now, as you can see from the chart, the line goes upwards in the early stages until about mid-1972, and you then have a very steep decline. So in this bear market, the decline in share prices was a shade over 70%, and it lasted from May 1972 until early January 1975, so a bit over 2.5 years. So it was long and it was brutal. And the catalyst for it, initially the market declined because the Bank of England in 71 and into 72 was raising interest rates to prevent overheating in the economy and control inflation. But the real kicker for this market occurred in October of 73, when Egypt, Syria and Jordan attacked Israel in what became known as the Yom Kippur War. That war lasted for about 3 weeks, ended in stalemate, but had a profound impact on the oil market, because the OPEC countries, which were a much stronger cartel in those days than they are now, were furious that the US had supported Israel in this war and imposed an oil embargo. And that caused a number of things. It caused the price of oil to quadruple from $3 a barrel to $12 a barrel. And it also caused significant fuel shortages. And they expressed themselves in the UK, and this chart is of the UK market, in the imposition of a 3-day week. So Ted Heath was Prime Minister at the time, and industries were only allowed to operate for 3 days in each week. And there were long queues at petrol stations. And to cap it all, the miners went on strike between November 73 and March of 74. So this was, quite literally, the lights were going out. It felt apocalyptic, and there were apocalyptic headlines in the newspapers. It was a very grim time. Nevertheless, if you look at the other side of this chart, you will see that markets recovered because the embargo was eventually lifted. There was a change of government in the UK. Ted Heath went to the country and lost, and Harold Wilson took over. Economic growth resumed, and as you can see, the stock market recovered. So this first chart looks at a 10-year period, and if I then go from there to the next slide, which shows a longer period, and the next one shows a 50-year period, which goes from 1970 up to June of this year. Now, that bear market that I've just talked about is the circle at the bottom left-hand corner of that screen. So when you look at it in the context of history, it looks insignificant. And you can see that the markets, there's a strong upward trend in the markets over that long time frame. And Chris and David have both alluded to this. So economic growth is positive over time with occasional recessions, and that economic growth in turn drives company profits, so they are positive over time with occasional setbacks. But even though the trend is strongly positive in the long term, you can see from the other circles on that screen, the first one is the bursting of the dot-com bubble. The second is the global financial crisis. And then the last one is the one we're in right now, the one that's been driven by COVID-19. So even though the trend is positive and upward in the long term, there are significant setbacks along the way. In the dot-com bubble, the fall was 50%. It was similar in the great financial crisis, and we know that this year markets fell by 1/3 in the period of about 5 or 6 weeks, and we don't know yet how this one is going to end. So if I can move on from there then to the next slide. What lessons can we derive from all of this? So I suppose the first one is that we know that bear markets don't last forever, but they can be extremely tough to live through. And a couple of points to bear in mind here. One is that bear markets are never the same. There are particular catalysts in each one. So you can't simply say, oh, well, this happened last time, so it's going to happen again this time. Each one is different. And also, looking back at the earlier charts, whether you're looking at 50 years or looking at 5 or 10 years, what you've got there is hindsight. And hindsight tells you exactly what has happened. If you're sitting here today wondering what's going to happen in the current bear market, you don't know. You have that lack of knowledge, that uncertainty that Chris talked about. So how do you handle this? Well, my second bullet point is if you're a disciplined buyer through the uncertainty, that can be very rewarding. But you need two things. You need a long-term investment horizon, and I would suggest a minimum of 10 years, and the capacity to absorb significant short-term losses. And bear in mind here, and this is a point that David made earlier, bear markets don't happen in isolation. When share prices are going down, you very often have recessions, falling corporate profits, etc. And think about the global financial crisis. As John mentioned, not only would the value of your share portfolio be going down, but the value of your house was going down. There was significant concern about the solvency of banks, so you might have been worried about your share deposits. So you've quite a few things coming at you, and in extremis, because unemployment rises typically in recessions and bear markets, you might be worried about losing your job. So there's a great deal on your plate. So what you need here is a strong discipline and a very strong stomach. Now, if you were to do that, the kind of rule that you might set yourself is, the official definition of a bear market is down 20% or more. So let's say you say to yourself, okay, if the market's down 30%, I'll put in some money. I'll put in some more if it's down 40% and some more if it's down 50%. So you need to plan that very carefully in advance. And that can be profitable, but you need to be extremely disciplined. And as I said already, you need a strong stomach to carry that off. If that's not your scene, what you need to do is say, what am I investing for? If you're investing, you need an investment objective. You need to plan the time period over which you're going to get there. You need to have a spread of assets, a diversification of assets, as David talked about, to give you a smoother journey to match your objective. So you need to have a plan and you need to stick to it. So John, those are my points, so I'll pass back to you.
Thank you very much, Michael. I'm just looking here, guys, at the questions coming in. So if you permit me, guys, I'm just going to run through a couple of these questions, and just to avoid people chatting over each other, I'll just pick on one of you to answer each of them. David, if I might start with you, I just think it'd be interesting questions come in as to what is either the best or worst thing you've ever done from an investment perspective. You just on. Sorry, David, we just can't hear you there for a second. Just you're on mute.
Beg your pardon? Yeah, and no, let me say just quickly, the worst thing I ever did, and the worst thing I ever did, we got heavily over-invested in financial shares in the early 2000s. Well, I won't go into the reasons why, but I did. And of course, financial shares were hit extremely badly in 2008. And I kept going. I didn't sell any of them, and that I think is the classic example of someone who's in love with a particular type of thing and can't give up that love, and that's the wrong place to be in investment terms.
Very good. Another questions that come in, I might direct this one at you, Chris, if I may. Just a very practical question. I think we've touched on parts of it here in all of our discussions, but the question directly is, if I have a lot of cash right now, is this a good time to be investing?
That's a great question. That's how politicians normally deflect from questions that are incredibly difficult to answer, which this one is. It's perhaps the most difficult question that I've most often been posed throughout my career, and it speaks to that chart that I showed earlier on, and which David also showed in a different way, about the ups and downs of markets. Because when you've got a lump sum to invest, you're always terrified that you're putting money in at the top, and you're about to go through one of those almost inevitable down periods. And that's particularly apposite at the moment, of course, with the markets and COVID. Because everybody reads every day, I think, in the financial press that a lot of investment professionals can't believe that equity markets have recovered to the extent that they have, and that with the United States numbers doing what they are doing, as John has described, a lot of people think that markets are arriving for a fall. And so at the moment, the question, as always, is incredibly difficult to answer. And I think I put my hand on my heart and say it's probably more difficult to answer at the moment than at any point in my career. So I go back to what we were saying earlier on, which is about the plan. Where does that question fit into your plan once it's formulated? And do implement that plan. Going back to that chart which shows the ups and downs of equity markets, it would be really lovely if we would naturally think to always invest at the bottom, sell out at the top, and get back in at the bottom. People, of course, have studied that and compared it to a simple plan. And the simplest of all plans is something called dollar cost averaging, or pound or euro cost averaging, which is steadily putting money into markets. And to ask over the long haul, what kind of difference do those two plans have? So if you have the perfect foresight thing that I talked about in my forecasting, compared to the investor that simply steadily put money in the market, the results of those exercises can be absolutely astonishing. Yes, you would do better if you picked those peaks and troughs, but the extent to which you will do better over the long haul is surprisingly small and really doesn't justify the expense of time, money, and emotional energy of being that perfect forecaster. So any plan should always have that pound or dollar cost averaging slowly, steadily, with a plan putting money into the markets. And I would echo that plan for now, in that if you do have cash to invest, formulate the plan and then implement the plan over some decent time period. It'll depend on your personal circumstances, but put money into the portfolio that you devise over a 1, 2, or 3 year period. Do some now, but don't do it all.
Very good, and a good advice. Michael, just coming back to you, first thing I just wanted to comment on something that you said, and I was very struck. You emphasized the point on the lessons for people about being disciplined. And immediately, and just listening to some of including David's answer to the question I just asked him, effectively the word comes to mind is emotion. And it strikes me that emotion is the enemy of discipline, if you like. And, I just want, and I suppose the comment I'm making from what I've heard from you and from the other advisors is that to counteract that, that's the plan and the advisor piece that can help to counteract that. And then just coming to the question, and I'm showing the equity market returns over 100 years, and as you know, that shows an upward trending sort of graph. This is done on a log scale to make it sort of more meaningful. But I do think it's important to listeners to understand, I know when we talk about this at our own investment committee, Michael, that our view is probably that the trend is upward, but maybe not as steep. You might just comment a little bit about expected future returns, please, and that line, the shape of that line, and whether it's as steep going forward.
Yes, well, I think as we said in our various comments, markets are a function of corporate earnings over time, and corporate earnings in turn are a function of economic growth. And economic growth over the long term has been positive, with occasional setbacks. I think the issue around the future is the divergence that Chris pointed out between the pace of growth of corporate earnings and where share prices have gone. And if that begins to diverge, then I think you need to be wary, and I think the likelihood is that future returns may not equate to returns of the past. And there's one other factor in here, which is about interest rates, because interest rates have been on a declining trend for approximately 40 years. And interest rates, actually both long and short term, around the world at the moment are zero or even less than zero. So when these interest rates fall, they lead to higher multiples for share prices, and that's a second driver. So you have the earnings themselves and the multiple that the markets put on earnings. So that there are two drivers in there, and in effect one of them is shut off because you can't go below zero on interest rates. So for the future, I think we would continue to expect economic growth and growth in corporate earnings, but we would expect it the markets to reflect that at a lower level than we've seen in the past.
Thank you, Michael. And I think it's something that I know when I chat to clients, I talk about, we can have, if it's a long-term horizon, we can have good confidence about the upward direction of that market because of the low interest rates. I think it's as wise to assume it'll be less steep going forward, but nonetheless an important driver of returns for people in their portfolios. Listen, guys, we're just out of time, so apologies I didn't get to all the questions. Thank you, people, for submitting those. As we close, can I just say a couple of things? Can I take the opportunity to thank those of you tuning in to this webinar? It will be available on replay as well, and that will get distributed to you. We hope you have found the discussion informative. Can I thank our speakers, Michael, David and Chris? And finally, can I thank the team behind the scenes, led by Samantha Condos, without whom this production could not happen. And with that, I will say thank you and goodbye.